But how do I maximize those benefits in retirement? Retirement is the place where you want the insurance. You want it now. If you're 30, if you're 20, if you're 22 years old and you just graduated from college, best time to start a policy is now.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
Hey, it's John Smallwood, and I am back on Money Isn't. I am continuing the conversation on life insurance. Hopefully you have found these to be of value. I am seeing some really interesting comments. So I bring those comments. I truly appreciate it. We will address some of those today. And the question I get a lot is, okay, I kind of get what you're talking about on life insurance. I don't want to do it. I don't want my family to profit from my death, but you want them to profit from your being here, because that's what's happening now. I'm joking about that. But the reality is this, right? If I properly orchestrate life insurance into your plan and you end up paying less taxes, you have less risk, you have more savings, you have more benefits and more protection around that wealth, you get to have more retirement income, and you pass more to your family, why wouldn't you want that, right? Why do you want to pay more taxes and have more risk and have less retirement income and pass less to your family? That's really the options here, right? And my belief is this, is that there's a multitude of financial products that are out there. Many of them are really, really good. Many of them are mediocre, and a lot of them suck, okay? And you want to spend the majority of your time defining the strategy, not based on the product. And what I find in this industry is that people are saying, shove all your money in this product, buy an annuity, buy life insurance, put all your money in there because you're gonna have a tax-free retirement. Put all your money in our registered investment advisory product because we know how to invest money. That's the marketing, right? All of that is absolute freaking bullshit, all right? And I just really wanna, it's the coordination of multiple products coming together designed in a unique manner for what you are and who you are, that's going to make sense, okay? And when you do that, you optimize your cash flows, you minimize the taxes, you minimize risk, you maximize retirement income, and you live a life that is the way you want it to be. And I believe there's this concept that says if I put money into life insurance, I'm going to give up return. And in the last thing we showed, a historical 9.25% return with 100% of your money in the S&P 500. No cash, no bonds, no nothing. That is just pure danger and stupidity. You could get very wealthy, but you can also get very unwealthy, right? Because of the liquidity of the pressures that present themselves along our time frame. Colleges, private high school, cars for the kids, shit happens in the house, brother-in-law needs money, mom and dad need nursing care and they don't have enough money. You want to join the country club, the lawsuit hits, the long-term care comes in, the failure to launch, uninsured property and casualty, weddings, yada, yada, yada. There's so many pressures that are coming at us, and all those require liquidity events, right? They require money available to take advantage of opportunities, right? So I'm painting a picture, I'm using a simulation that I believe is unrealistic because nobody ever has 100% of their money in their equities unless they're building a business. But they always diversify. We just saw some of the biggest, most wealthiest people sell big blocks of stock to reposition assets into other assets. Why? Because they want things, they diversify, they want to put it in real estate, they want to put it in NBA teams, they want to put it in all kinds of cool stuff, right? Because they want to diversify to, one, generate different streams of income, two, to have more assets, three, to have more enjoyment, right? So I'm picking up on the last meeting here, but I want you to realize that I'm going to dive into a 10 pay, a 20 pay, a whole life 100. And I'm going to basically talking about there's a time and a place for every kind of product, right? But the focus, sometimes our focus is on the wrong thing, right? So when I buy life insurance, regardless of the type of life insurance, whether it's universal life, whole life, or term insurance, there are provisions that are going on that require the insurance company to put away a certain amount of reserves, which reduces the early liquidity. The higher the death benefit on the product, the higher the reserves that are going to be required by the insurance company, and therefore less premium going into it. Okay. So what I'm doing today in this simulation is we're showing death benefit to death benefit, meaning $1 million 10 pay, $1 million 15 pay or 20 pay, and $1 million whole life 100. In my 35-year-old scenario who makes $250,000, has saved up $400,000, the visual is on either Spotify or YouTube on this, right? So we did the previous one. I'm using the exact same position where we ended. We basically did a simulation where we showed if the person did not have any life insurance and they just simply invested the money they'd have in the S&P 500. We went over the tax. We basically said a third is getting taxed. A third is getting taxed as ordinary income. A third is getting taxed as capital gain. And a third of the portfolio is unrealized. We're using the S&P just to kind of reiterate this from 1988 through 2023. The average rate of return on it during that time frame is 12.42. When we factor in taxes, market volatility, adjusted and those adjustments is down to 9.25. It generates $14,977,000 with a unrealized tax liability of $1.4 million. I've overridden the taxes and I'm assuming 20% on marginal ordinary income and 20% on capital gain. If you're making over $500,000, you're in a higher tax bracket. You're in a 36 going towards a 37. When the tax law sunsets in 2025, who knows who's going to get elected? So that's an argument that I don't want to go down. The top bracket goes up to 39.6. So I'm underestimating taxes potentially in this strategy. You know, Biden was talking about capital gain rates going to 45%. I'm sure the other people that are now being, propped up here for the election. Now you might not even be reading this till after the election, right? Or seeing this when we're recording this. I have no idea when this is going to come out. But the reality is the taxes will erode the capital, okay? We don't know what the future interest rates are going to be. We don't know. Past performance is no guarantee of future success. I don't know what the dividend rate on a life insurance policy is going to be. I don't know a lot of things. And anybody tells you that they do, you should run away, okay? Because there's so many variables that are going to affect your financial plan. So many, okay? So all I want for everybody listening to this is to have the best possible plan they can have that has the most amount of protection with the least amount of cost. They accumulate the max amount of money that they can. They enjoy it during retirement to their fullest while they can. And when shit happens, there's a thing to clean up all the shit, like a death benefit, right? Long-term care, medical expenses, stuff going wrong, inflation. And I want you to pass the maximum to your family. If that's what you want, then we're a really good fit. Okay. If you want something different, there's a whole thing here. Now, proper structure of a plan is going to use your money at all times, meaning your money's in motion. Economics, there's a concept called the velocity money and the money multiplier effect. When we hoard money and we keep it stagnant and it's not in the economy is not good. So when banks don't lend money, the economy goes into restriction. We go into recession when banks lend money. And that's what's been happening. Banks are not lending money at the same rate that they are. So it's causing all of this fear. And people aren't borrowing because interest rates are high. Now, I'm recording this, 10-year treasury is about 4%, 2 years about 4.6. Money market rates 18 to 24 months ago were below 1%. They're 4.5 to 5, depending upon where they are. Long-term mortgages were 2.75 24 months ago. They're now 7.5%. But 18 months ago, my money was making less than 1%, and I was happy borrowing money at 2.75, right? Now my money's making 5, and I'm not happy with the same spread at 7.75. My money's making more money. The math is the math, okay? Yes, I want the 2.75, but I'm much more happy having my money making 5% in the bank, okay, regardless of the tax on it. I digress for a second because you need to think that your money in motion, money sitting in one financial product and doing one thing by itself is not good for you, okay? Your money in motion, you utilizing the dividends to go from the portfolio into life insurance, back out of life insurance into something else, into an investment, into something else, or you staying there. Your plan is going to dictate what you're going to do based upon who you are and what you're trying to achieve. But you want to have access to your money, right? And having access to your money at times when things are difficult, meaning stock market's up, taxes are high, and I got a big tax liability. I'm not going to, I'm going to borrow money against my money. I don't want to pay those taxes, which creates more risk, right? Or the market's down 50%, and now I need $100,000 for this goal that I was going to do. Am I going to be comfortable doing that? No. So I got to have money in different silos. I got to have money sitting in cash. I got to have money sitting in life insurance cash values. I got to have money sitting in real estate. I got to have money sitting in, stocks, bonds, mutual funds, ETFs, et cetera, deferred comp, retirement plans, different tax treatments. That's not the argument of this conversation. Okay. So I'm putting this in context right now and saying the unprotected portfolio with no life insurance got to 14.9 million. Yoo-hoo, that was great. And we got a $1.4 million tax liability that you see on the screen. We go to a life insurance guy and he says, buy some term, but you're going to need the term for 40 years. So we buy the 40-year term. Now you can buy 30-year term. You can buy 20-year term, which is cheaper. You can buy 15, which is cheaper. You can buy 10, which is cheaper. But, when the 20-year term becomes, you look at the 20-year term, there's a whole bunch of insurable stuff, which we'll talk about. But the idea is that now drains your portfolio down to 14.724, and I got a $1.4 million tax liability, and I still have this $1 million 40-year term that's still around at 68. We're going 35 to 68 using that S&P 500, netting the taxes from the portfolio, showing volatility adjusted returns, showing all of these things, right? And when we look at it, what we're seeing is as the money grows, the fees in the portfolio compound, right? They go from first year fees on this portfolio were about $4,000 because you got $400,000 invested. And the taxes on the portfolio are $10,984. I get to 68. My fees have compounded to $122,000. My broker took me from 400 to 14 million. I'm a very happy person, right? My portfolio tax has gone from 12,000, 10,984 to 576,000 compound taxation, and has dropped my wealth. With the term insurance, I'm now down to 14,724. So 250,000 plus, off the bottom of my account for the $1,500 a year premium. Then what we did in the last one is we said, let's do a whole life 100 where it's $1 million death benefit. Premiums 12,000 or 13,000 with waiver of premium. So if I become disabled, the plan is self-completing. So the cash values continue to happen, meaning 13,250 is getting paid into the policy. At 68, the waiver of premium is off and the premium's down to 12,890. But I got $1 million of cash value and a $1.8 million death benefit at this time. So I've got a heck of a lot more death benefit and a lot more assets. Not a lot more assets. I've got 13.8 million versus 14.7. So there's a $900,000 drain. That's like a quarter of a point. Now we're looking at historical performance in the S&P, which is after tax volatility adjusted at 9.25. And we're moving money into a current dividend scale at 6.1, internal rates of return on a whole life about 5.5 over that time frame. So you're taking money from 9 and you're putting it at 5. There's no tax on the life insurance, which is why you're doing it. You want the life insurance to be permanent. You want to have access to that cash. You want to use it as an emergency fund. You might want to use it for college. You might want to use it for something else, right? But you're getting to the same spot with less risk. Now, we're going to talk about what people are like. When you look at these whole life 100s, you're looking at this and saying, gee, for the $13,000, the first year cash value is zero. I put $13,000 and it's zero, but I get the $1 million death benefit. And over time, all my cash comes back and I make a return on that capital. But my death benefit's increasing all the way through. So by the time I'm 69, 70 here, there's the dividend on the contract is $27,000 under the current scale. Cash value $947, and the death benefit's $1.8 million. All right, so making a return on my money. The guaranteed cash value is $460, which assumes a dividend was never paid. Now, once a dividend is paid, it becomes part of the guarantees. And the company I'm showing, which is Mass Mutual, has never missed a dividend since they've been paying it for 150 plus years. Now, interest rates will rise. This will go up. But that doesn't matter, okay? What I want to talk about is I'm here and I'm going to, I'm concerned about the liquidity in the contract in the first year. I've got $400,000 in my portfolio. I really shouldn't be concerned about the short-term liquidity. I'm looking at the life insurance for a long-term vehicle, and I want to have money working in other places. And assuming these are my two investments, the money in the life insurance and the money in the portfolio for a second. No other investments happening, okay? That could all happen if we're doing this properly, okay? But what I want to do is I'm going to say, well, we can, instead of using a whole life 100, we can use what's called a 20-pay whole life. The premium's going to be higher, but it's going to have more liquidity in the first couple of years. And the reason why I'm digging into this is because I want you to psychologically understand that the liquidity early on is not what I want. It's the liquidity later on that I want, okay? But when I do this, the same concept, I'm now repositioning, instead of $13,250, I'm repositioning $24,910 for the same $1 million death benefit. And what's happening is that premium is paid for 20 years. So by the time I'm 56 years old, there's no more premium. I cannot pay it by contract. There's no way I can put any more money in. Now, I was looking at the 25-year-old policy that the internal rate of return is about 5.5%. If I pay the premium on my own policy, I get about a 5.5. If I don't pay the premium, I get about 5. Well, where can I get 5.5 tax-free right now? I want to pay that premium, but contractually, I can't pay it. So my point is, when I look at this at the same 68 mark, because I took more money out of the market, even though I had more liquidity in the 20-pay whole life, instead of having $13,795,000, I've got $13,285,000. So the decision to get money into the life insurance, now we are using historical performance for the S&P, and we are using current dividend scale and extrapolating it into the future as if it never changes. We're not using historical performance here, but it's about a $500,000 ding in my future value. And when I look at this on the 20-pay concept, my cash value at the end of the first year is $7,500. Well, I put out $10,000 more to get $7,400 more in liquidity in the policy. I don't know if that makes sense. I don't know. Yes, I get much cash value. I get, cash value quicker. Policy is paid for quicker. The dividend at 69, because it has more cash value, is $42,000, and the death benefit is 2.2. I got to trade off. I don't know which one in the moment is going to be more valuable. Now, somebody that's older, this may make more sense. But when I do this, every time I do this, I have a trade-off, right? So now there's this, I go to a 10-pay policy, which is a very popular thing. We see it, 5 pays, people stacking money, getting as much money into the life insurance. They're afraid of the stock market. They're afraid of doing things. But the 10-pay, now, just to look at this on a mathematical basis, the 10-pay, instead of being $13,000, is now $59,420 for the same $1 million worth of coverage. And that's payable for 10 years. So at the end of the 10 years, there's a lot of cash value. There's $700,000 of cash value in that policy in the 11th year. And by the time I get out to 69, because I put a lot of money, 68 in this policy. So now, if I'm looking at these three scenarios side by side, I've got $80,000 in management fees versus $99,000 in management fees versus $107 versus $122. My taxes are $378 versus $465 versus $505. Now, if rising taxes, this would be a really interesting thing. I got 2.2 million in cash value for a total of 11.8 versus 13.7. So it's like a $2 million drag on the account by stuffing the money into the life insurance, right? And leaving it there. So when I look at the 10 pay, here's the 10 pay. You could see I put out almost 60,000, 59,420 versus the 13, and I have $21,000 of liquidity. And I pay it for 10 years and I can't put it in after 10 years. And when I get out to 65, because the policies had a lot longer time to accumulate cash, it has significantly more cash, but that dividend at 69 is 84,000 on the current projection versus 43 on the 20 versus 29 on the whole life 100. But optimally, I've actually created less wealth unless I take the money and I use it from a velocity of money standpoint, where I take money out and I move it to other investments or even back into my investments. But I still lose the ability to continue to put money into that contract for the longer run. And that's what I'm saying is, if I step back into the real world for a second and I look at what's my family needs, does it make sense for me to tie up a lot of money right now into a 10 pay whole life at the age of 35? Maybe at 60, it does, right? But is it more important for me to have more death benefit? For the same premium, I could have $3 or $4 million of death benefit and get to a really wonderful thing. So I can have 3 to 4 times the amount of death benefit, which is the important thing. And it's the net death benefit that I really want in my retirement, which in all three scenarios seems to be very similar, right? It's 816, 817, and 895, but I've given up $2 million of capital to get there. So in a rising tax rate, which one works better, right? Potentially the life insurance because it's not getting hit with taxation. But there's an optimal blend that I'm trying to get everybody to. And what I wanted to do today on this conversation was to look at this and say, let's focus on the right things. Let's focus on protecting. Let's focus on the long run. Let's focus on the short run, right? And blend those two decisions together. And this does not take into account the myriad of ways to pay for a policy, right? There's multiple different ways. There's finance premiums. There's all kinds of things that could be happening, but many of those are not appropriate for most people, right? I'm talking about this is a very structured process, right? Optimally, I do want to have more cash value in my plan. I do want to have that greater cash value in the future, but what's the rush to get it all in there? If the market's down, I want to take advantage of a down market. Cash values are going to help me do that. If I'm retired and my portfolio drops 50% or 35%, I'm going to be a lot better off because I have the access to the cash values. If I look at a traditional plan and I said, is it appropriate for me to have 100% of my money in the S&P 500, or should I do some combination of cash and bonds? That return is going to drop, and now the life insurance policy is going to perform relatively better because it's similar to bond-like cash values. So my concept is I probably want to reduce bonds as I develop cash value to reduce risk, right? I don't need to have a ton of bonds when I have a ton of cash value. But what I want is I want to have the maximum income in retirement. I want to have the maximum flexibility along the way. I want to have access to my capital for emergencies and opportunities, but I also want to maximize the death benefit. If I could get to 65 and have relatively the same $13 million, $14 million of capital, but have $4, $5, $6, $7 million of death benefit, that's a much better plan because then my cash value would be 15 to 20%, maybe 25% of my overall value, which is going to increase my retirement income because the dividends on those policies, if I have 4x the dividends that I have in the whole life 100, because I did 4 times the whole life 100 for the same premium as the 10 pay, I've got well over $100,000 of dividends that I could take out tax-free, right? I've got the permission slip of the death benefit. How do I use the death benefit creatively in retirement to be an inflation hedge, to be a market volatility buffer, to be my long-term care solution, to be my inheritance tool, to be my permission slip for pension maximization, for buy downs, for annuitizations, a whole series of things. Like there's a list of 30, 40 things we can do in retirement if the person has death benefit. If they don't, it's a pretty significant thing. Now, if I'm really successful and I have over, in today's dollars, over $26 million, anything over $26 million is subject to significant inheritance tax. So you see very, very wealthy people buying life insurance to cover the inheritance tax. They don't need life insurance, but 9 months from the date of death, if I have a $100 million estate, let's say my $100 million estate is tied up in real estate and stocks, I have to liquefy about $30, $40 million of that very, very quickly to pay inheritance tax. If I have $30, $40 million of life insurance, the family can make a decision to liquidate something or not, keep the cash, or use the cash to pay the inheritance tax and keep the assets. Now, rumor on the street, a big sports team many, many years ago was about $1.5 billion worth, and they supposedly had about $750 million of insurance. And when the owner died, there was the 1 year in which there was no inheritance tax, but you didn't get a step up in basis. So the family got to keep the $750 million and not give it, and keep the team, local team. That is magical, right? Now, let's talk about access to cash value as an emergency vehicle. You look back in time, in history, available money is Aladdin's lamp. You've heard me say this before, right? Aladdin, the genie, if I have available money, I can take advantage of down markets. I can take advantage of opportunities. If I have no money, let's say I have money all in the S&P and the market drops 50%. I don't have any liquidity to take advantage of that 50% drop. I want to have money in different buckets that have different tax treatments. The beautiful thing of the life insurance is it's a safe, secure asset. It pays a very competitive rate of return relative to other products. It grows without taxation. I can generate tax-free income. The cash values are creditor proof in most states, meaning they can't be taken away in a lawsuit. The death benefit is rising, and I can get access to my money at very low cost. Like I had this conversation with a client recently where we had significant cash value that you're going to borrow. You're going to pay about 5% loan, but the policy's making 4.75. So your cost of money is about a quarter. Or you can liquidate money out of your portfolio, but you got to pay 25, 30% in tax to get that liquidity. Which one do I want to use? And when I drop the money out of the portfolio, I lose the opportunity on that. I borrow the money from the life insurance is still making money because it's a collateralized loan. It's not pulling your money out. Now, could I use a collateralized loan from, a big entity, an asset-based loan? Yes. Rates are 7.5 at this point in time. So I really want you to get that, right? I've been doing this for 35 years and everything has changed. Tax rates have changed. Products have come and gone. They've gotten better. They've gotten worse. But this whole life concept's been here forever. And it kind of gets knocked down in a whole bunch of ways that doesn't make any sense to me. When you view out and you scan out and you look at the big picture, it looks completely different when you look at all the variables, right? And you want to look at all of the variables. If you don't look at all the variables, you're not looking at it in the right way. And if you look at what does it mean for a normal family, husband and wife, work for companies, got money in a 401k, maybe wife was a school teacher, we got the pensions. How valuable it is to have the life insurance in the plan. Think about this for a second. Husband and wife, Social Security combined, let's say $75,000, each paid in at the maximum dollars. Wife's got a pension for $50,000 with a 50% survivor benefit, or husband. It doesn't really matter. And they're taking a distribution from their portfolios. And one dies. We lose the Social Security, $35,000. And depending on who dies, the pension gets cut in half. So we lose a significant amount of money. If I had the proper amount of life insurance in play and somebody dies, yes, I lose the Social Security. Yes, I lose the pension. But now I get a big lump sum of death benefit that might, if I get $2 million of death benefit that was paid for, part of the plan giving us income, now I've got the $2 million. Now I get $100,000 a year at 5% off the portfolio. Maybe I got $1 million. It's $50,000. But how do I maximize those benefits in retirement? Retirement is the place where you want the insurance. You want it now if you're 30, if you're 20, if you're 22 years old and you just graduated from college, best time to start a policy is now, because your cost of insurance is the cheapest it'll ever be. You want to pay that sucker not for 10 years, but for a long time, because you're going to work and live a hell of a lot longer than anybody recording this thing right now. Okay? In theory. This is not a discussion about my investment's better than your investment. This is a discussion about the two investments together are better together because they come together in a unique, harmonious way. And if you orchestrate it properly, you get to the same point, but you have more benefits and more protection, more income, you pass more to your family. That's what we're talking about here, okay? So the visuals are on YouTube. The visuals are on Spotify. You can stream it both places. If you're listening to this on a source that you're just hearing the audio, please go check out the visuals. Give me comments. I'm going to dedicate a whole podcast to just life insurance in retirement and different strategies. And we're going to focus on universal life. We're going to focus on different things. Thank you for listening. This was a hell of a lot of fun, and hopefully you got some value out of it. And if you did, subscribe, like, share, and send me feedback, whatever that you need to do. I want to hear from you. Thank you.